Question 71. A risk manager at an investment consultancy firm is projecting a return of 14% on portfolio Y. The market risk premium is 15%. The risk-free rate on interest is 5%. And the volatility of the market portfolio is 18%. Portfolio Y has a beta of 0.6 according to the capital asset pricing model, or CAPM. Which of the following statements is true? A, the expected return of portfolio Y is more than the expected return of the market portfolio. So this is going to be incorrect, and the way we can reason that is portfolio Y has a beta of 0.6. So a beta of 0.6 would lead to a lower return of that asset under capital asset pricing model, which assumes that markets are efficient. So lower beta will lead to lower expected return, higher beta will lead to higher expected return. B, the return of the portfolio has more volatility than the market portfolio. Again, this will be incorrect since we have lower beta. Lower beta is going to imply lower volatility. C, the expected return of portfolio Y is less than the expected return of the market portfolio. It sounds like it will be our answer based on what we've said for A and B so far. And then D, the expected return of portfolio Y is equal to the expected return of the market portfolio. So that's going to be incorrect also based on what we've kind of deduced here so far. So let me just pull in that formula and we can make that calculation as well. And we can see that how that's going to work out. So our CAPM is going to be that risk-free rate. So we've got 0.05 there. And then we're going to add that to the beta times market risk premium. So our market risk premium is 15% and our beta is 0.6. So that gives us an expected return of 14%. And just keep in mind, this is the market risk premium. So the market return is actually 15 plus the risk-free rate of 5. So the expected market return is 20. Expected return on this portfolio is 14. Answer C. Question 72. Consider a $75 call option on a non-dividend paying stock where the stock price is $68.30. The risk-free rate is 5%. The time maturity to volatility is 120 days. And ND1 is 0.3311. A 1% increase in the volatility will increase the value of the option by approximately. So to understand how volatility increase is going to affect the value of the option, we need to know what our Vega value is. So the Vega of a call option is going to be right here, which is going to be equal to that stock price, which would be our S variable, times the square root of T, which would be 120 days over 1 year's worth of days, so 120 over 365, and then multiply that by ND1, which is given right here at 0.331. And so when we pull that in, we can see what we get there. So we get 12.97. So then we're going to multiply that 12.97 by a 1% increase in volatility, or 0.01, and we see that gets us 0.1297, which aligns with answer C. Question 73. Consider a random variable x with a known probability distribution. Suppose we define a new random variable y as a linear transformation of x, such that y equals ax plus b, where a and b are constants. Which of the following statements correctly describes the effect of this linear transformation on the statistical properties of x? All right, so we've got A, the mean, median, and interquartile range of y are all scaled by A and shifted by B, while the variance, standard deviation, skewness, and kurtosis are unaffected. So where this is going to go off the rails a bit, so mean, median, and interquartile range, those are all correct so far. The variance and the standard deviation are also going to change. So skewness and kurtosis are also correct. Those will be unaffected, but this variance and standard deviation will be affected and by this scaling it mentions here. So we can go ahead and rule out A. B, the mean and median of y are scaled by A and shifted by B. Correct so far, which was the same as up here. The variance and standard deviation are scaled by A squared. So this is also going to be correct. So we're good so far. Skewness and kurtosis remain unchanged, which is correct. And then the interquartile range is scaled by A. That's also going to be correct. So we'll go ahead and give B the nod for now. Let's make sure we can rule out C and D. The mean, variance, and standard deviation of Y are scaled by A and shifted by B, while the skewness, kurtosis, median, and interquartile range remain unaffected. So we're going to be incorrect here on median, variance, and standard deviation. So we can go ahead and rule this out. And then for D, the mean, variance, standard deviation, skewness, kurtosis, median, and interquartile range of Y are all scaled by A and shifted by B. As we've established earlier, that's not going to be true. So we'll stick with answer B. Question 74. A European call option on a non-dividend paying stock has the following details. So we've got current price, strike price, time to maturity, and the risk-free interest rate. What is the lower bound for the option price? So our lower bound formula is going to be pretty straightforward. So it's going to be our current stock price, which will be 21, given right here. And then we're going to subtract the strike price discounted back for the time period that we're looking at. So our K is the strike, which is going to be at 20. And then we're going to discount that back at using the continuously compounding variable at minus R, since we're discounting. So our R will be 0.1. And then since we're looking at 6 months to maturity, we're going to multiply that R by 0.5. And when we do that, we get $1.98, which is going to correspond right there with answer C. Question 75. Which of the following best describes the relationship between independent events and mutually exclusive events? So before we look at these answers, independent events are essentially going to be two events that they are independent of each other, so they have no bearing on one another. So the probability of one doesn't really affect the probability of the other. And then mutually exclusive events is going to be where two different events, only one of them can happen for the given time period or for the study. So it's either going to be event A happens or event B happens. You can't have both of them happening at the same time. So that in mind, let's dig in and look at these answers. So we've got A, if two events are independent, the occurrence of one increases the probability of the other. Independent implies that one happening has no effect on the other, so it shouldn't increase that probability, so we can rule that out. B, if two events are mutually exclusive, they can both occur at the same time. Goes against what we just mentioned earlier, which is they would both not be able to occur at the same time. If two events are independent, the occurrence of one does not affect the probability of the other. Sounds like our answer so far. Let's make sure we can rule out D. If two events are mutually exclusive, the occurrence of one does not affect the probability of the other. This is going to be incorrect. The probabilities of two mutually exclusive events should add up to 1. So if one of them has a probability of 50%, but that goes up to 60, that means the other one has to drop from 50 to 40%. So we can rule out D as well, and we'll stick with answer C. Question 76. You've been given the following spot rates table. So we've got maturity at half year, 1 year, 1.5 years, and 2 years in those respective spot rates. If a 2-year bond with a principal of $1,000 pays a semi-annual coupon of 8% per year, then which of the following is closest to the theoretical price of the bond, assuming continuous compounding? So we're assuming continuous compounding, and what we're essentially going to do is we're going to take all of our cash flows. So we're doing semi-annual coupon at 8% per year. So since it's semi-annual, that'll be 8% multiplied by that principal of $1,000, and then divide it by 2. So that's going to be $40. Will be our semi-annual coupon. We're going to take all the cash flows at these next four coupon payment periods, and we're going to use these spot rates to discount those cash flows back to the present. We're also going to discount the principal by that 2-year number, so 5.5%. So that's this is what that's going to look like. So we've got our 4 cash flows here, 40, 40, 40, and then 1,040, since we're getting coupon and principal on that last payment, and their corresponding spot rates. So for the 0.5 year, we've got We've got 4%, and that corresponds right here. So we're going to have 0.04 times 0.5. And then for the 1 year, we've got 0.043, and that's just multiplied by 1 since it's 1 year. And then again down the line. So 4.9% times 1.5 and 5.5 times 2 comes out to 1,046.36, and that's going to be closest to answer A. Question 77. An investor wants to implement a strangle using put and call options on the shares of UUKL. Which of the following pairs of options is he most likely to choose? So a strangle using a put and a call, we're going to be buying both of these options. And for the call option, it's going to be at the higher at a higher strike price than the put option that we buy it at. So we might buy the put with a strike of 20 and the call might be 25 or something like that. And those are going to have the same expiration date. So we're looking for buying each of these options, same expiration date, different prices. So we've got A, buy a call option with a strike price of $30 expiring in 6 months, and buying a put with a strike price of $30 expiring in 6 months. So we're buying both the options, that's good, and we've got the same expiration date, 6 months, but where we mess up here is that strike price is the same. This is going to be a straddle strategy, not a strangle. So we can go ahead and rule out A. B, buy a call option with a strike price of $30 expiring in 6 months, and buy a put with a strike of $30 expiring in 3 months. So here we were aligned on strike. We bought both the options, but we have different expirations, but we need the same expiration, different prices. We'll rule out B. C, buy a call option with a strike price of $30 expiring in 6 months, and buy a put. So we're buying both. That's good. With a strike price of $25 expiring in 6 months. So we've got expiration right, we're buying both, and we've got the call option price at $30, which is higher than the put option at $25. Sounds exactly like our strangle definition. Let's make sure we can rule out D. Buy a call option with a strike price of $30 expiring in 6 months, and buy a put with a strike price of $25 expiring in 3 months. So here we had buying correct, and the strike prices were good since the call was higher than the put, but expiration's no good since those don't line up. So we can rule out D and stick with answer C. Question 78. A fixed income trader summarizes in the table below the prices of Treasury bonds with semi-annual coupon payment. The data is as of 01/01/2017. So we've got tranche 1, tranche 2, and tranche 3 with 3 different maturity dates, it looks like, different coupons and different prices. What are the discount factors for 0.5, 1, and 1.5 years? And so we glossed over these dates here, but our data is as of 01/01/17, and we can see this bond matures halfway through the year. This bond matures at the end of the year, and this one matures in a year and a half. So this is going to be our 0.5. We're going to use this bond here to calculate our 0.5 discount factor, which is what we're looking at. And then our 1 year discount factor will be tranche 2, and then our 1.5 year discount factor is going to be tranche 3. Sorry. So let's pull in some more info here, and then we'll start looking at how to calculate that. So essentially what we're going to be doing is setting our price equal to each of the coupon payments, and then multiplying that by the discount factor. And then we're going to do that for each of the coupons, and then we're going to add in the principal multiplied by the discount factor. So we're given price in all these instances, and the coupon and the principal. So we're going to need to then set our discount factor variable as X, and then kind of do some algebra to figure it out. So for the 0.5 discount factor, we've got a price of 99.0. So that's going to be 99 is going to be equal to our principal times discount factor plus our coupon times discount factor. I just did this one as one kind of whole parentheses here, but you could break it out more. So it's basically 99x plus 3.5 divided by 2x, since we've got a coupon rate of 3.5%. And then we're dividing that by 2 for, where does it say? Right here, semi-annual. So that gives us 99 equals 101.75x, and we solve for x here, we get 0.97296. So when we look at these here for 0.5, we've got 9730, which would certainly look good for if we round this up. We've got 9551, so that'd be incorrect, 9633, and 98990. So if we were in a hurry, we could just go ahead and choose A and move along. But for the purposes of learning, we will dig in and calculate the rest of these. So for the 1 year, the difference here is we're going to have 2 coupon payments. So our coupon is going to be this 4% divided by 2, so it'll be 2. So we've got 2, and then we're going to multiply that by the discount factor that we got for 0.5, so 9.97296, that's plugged in here. And then we're going to add in that second coupon plus principal that we're going to be receiving at the 1 year payment. So it's going to be 102 times x. So we get 98.55408 equals 102x. We solve for that and we get 0.9662. And then you can kind of see where this is going. So then we're going to take our price at D, or at the 1.5 year mark. Sorry. And then we can see this does correspond here. So that's good so far. So then we're going to use these discount factors in here as well. So at that halfway mark, we're going to take 2.5 coupon, which we get by 5% divided by 2. We're going to plug in the discount factor at 0.5 years. We're going to add that to 2.5 times this discount factor here, which is plugged in there at 0.96622. And then our last coupon of 102.5 times x. So this is our 1.5 year discount factor. And we'll just do that algebra right down the line. Gets us to 0.93929, which we round. That also corresponds there. So we are good with sticking with answer A. Question 79. An increase in which of the following factors is likely to cause the price of an American call option to decrease? Which one? So we're looking at an American call option. So generally, if we are looking at call options, we are if we're long this, we are bullish. So if the stock price goes up, that's going to be good for our call option relative to the strike price. So we've got A, current stock price. So an increase in the stock price, is that going to lead to a decrease in the call option? That's going to be a no. If our stock price goes up, we're going to be more likely to be in the money. If we're more likely to be in the money, that's going to be better for the call option value. B, strike price. So for the strike price, if the strike price increases, that means we're going to be less likely to be in the money. So opposite from A, if our strike price increases, if it goes from say $50 up to $60, but the current price of the stock is $50, we were at the money before, but now we're out of the money. So that's going to make this worth less. Not worthless, but worth less. So it looks like B, strike price, will be our answer so far. C, volatility. When volatility goes up, that is going to lead to a increase in our option, and that's going to be the same for calls and puts. When volatility increases and you're long a call and a put, you're more likely to end up in the money. So that's good for you. Or good, not good for you, but good for the value of the call option. And then D, risk-free rate. So an increase in the risk-free rate is generally going to increase the value of a call option since it's going to lower the present value of the exercise price. So it's going to technically lower the present value of the stock price, which will increase the likelihood of being in the money. So we will stick with answer B. Question 80. The price of a Treasury bond, which has a coupon of 10% paid semi-annually on April 25 and October 25, is quoted 103.05. The last coupon was paid on October 25, 2017. If the current date is March 28, 2018, and the bond will mature on October 25, 2030, the cash price of the bond is closest to. So for Treasury bonds, we're going to be using actual convention. Just want to note that. So our cash price is going to be equal to that quoted price plus the interest accrued. So quoted price is going to be given right here. So it's 103-05. So as a reminder, this -05 is quoted in 30 seconds. So it'll be 103 plus 5 divided by 32. So we've got our quoted price, which is a little over 103. And then our interest accrued is going to be number of days since last payment divided by number of days between payments. And then multiplied by coupon rate, time, and face value. And since we're using actual convention for the Treasury bonds, we need to know the kind of exact number of days here. So on the exam, you'd probably be given the number of days. They wouldn't be kind of making you calculate the exact number of days between these years and dates here. Anyway, so we've got number of days since last payment, which is going to be 154, and then number of days between payments, which is 182, multiplied by that coupon, which is semi-annual, 5%, and then multiplied by 100 face value, gets us 4.2308. So we're just going to add this to that quoted price, which gives us 107 and some change, which corresponds right here with answer A.